Dear friends and investors, welcome to one more of our monthly communication on markets and investing. So what are we going to focus on this month? Well, dear friends, as you all know that over the last couple of months and quarters, we have been highlighting how market leadership in this bull market cycle post-COVID has substantially changed. There are sectors which were completely lagging pre-COVID, which have now suddenly become leaders in the bull market. And one such sector is real estate. It's a very important sector, both from an economy perspective and also from an investment perspective. Now, when I say from an investment perspective, I don't just mean investing in physical real estate. What I mean is that we will look at why we are so bullish on real estate stocks as a sector that we should look for investing over the next couple of years. Before I start, one factoid. Which sector did or delivered the best returns and outperformed the market by a huge margin in financial year 23-24? Friends, it was the real estate sector. We don't talk about it much because much larger sectors tend to take a lot of our time, but we believe that this is a sector that we cannot ignore. So what we did was that we studied how real estate as a sector in the stock market across several markets and economies have done. So what we did was we looked at a couple of emerging markets as well as developed markets. And what we found was that the total market cap of the real estate sector, that is all the listed real estate companies to the total market cap of those countries, we found that India is still way low in the pecking order. In fact, as of December 2023, Vietnam, the market cap of the real estate to the total market cap was almost 11.5%. In Mexico, it is 6%. In US, it is 2.5%. In Indonesia, it is 2%. In China, it is less than 2%, but mind you, this is after a big meltdown in the Chinese real estate industry. And in India, it is also at 2%. So when we look at the total market cap, the market cap of real estate to the total market cap, we believe that there is a significant upside from here on. As you know, friends, we all talk about that India is going to be a $10 trillion economy in the next couple of years. One of the other things that we looked at across all these markets was that as the GDP per capita, which means you take the total GDP, you divide it by the population, you come to GDP per capita. What we saw across markets, whether developed or developing, was that as GDP per capita starts to increase, the ratio of real estate in the total market cap of those countries also increases in line. And whether it was Vietnam, Mexico, US or Indonesia, we looked at least for the purpose of this study, these four large markets. We found that in each of these markets across years, we have seen that as the GDP per capita increased, the spending on real estate increased proportionately and in some cases disproportionately. And this happens because as your per capita income rises, you have more surpluses, which means your affordability to buy a house increases dramatically. Now, if you come back to India, and if we look at the same data for India, we find a very, very interesting trend. So we looked at the data of real GDP growth and the share of real estate in the total market cap. And we stripped our entire study into a few time periods. The first time period for which data was available was from 2002 right up until 2007. Now, during that period, as you all know, that was one of the greatest period of economic expansion in India, and that was also one of the finest bull markets that India had seen, where the Nifty went from 1,000 to 6,500, the Sensex went from 3,000 to 21,000. During that period from 2002 to 2007, India's GDP per capita compounded at 17% a year. And at the starting of 2002, the total market cap of the real estate sector to the total market cap was only 0.2%. But at the end of 2007, that figure went up to a staggering 6.4%. And thereafter, if we look at 2007 to 2009 or 2009 up until COVID, our GDP per capita compounded somewhere between 4 to 5% a year. So much slower than the earlier period. And what happened? From a peak of 6%, the weight of the real estate in the total market cap fell all the way down to 1.3%. And why did this happen? Because our per capita GDP did not grow higher than even inflation, right? So which means that as our per capita incomes were increasing, inflation was eating away most of that purchasing power. There was not much surplus that was left to invest substantially in housing. And therefore, as you all know, that the real estate industry also during that period went through a very tumultuous time. We had a lot of developers which went bust. They were over leveraged, and therefore there were a lot of unethical practices that happened. It was an industry which was largely working on cash, and therefore we had a complete destruction of the real estate sector in the stock markets. And therefore that period was almost a lost decade. However, things changed post-COVID. As you all know, friends, we were all holed up in our houses during COVID. There was this whole work from home, which became the norm. And that's when suddenly everybody realized that they need bigger houses if they have to start working from home. And one of the trends that we started to see is that people started buying bigger homes. Everybody wanted that one spare extra room so that they could use it for the purpose of work from home. And from there the trend started. And if you look at the year from 2020 to 23, where India's GDP per capita compounded at almost double digits, it was at 9% per annum. And what happened? We started to see an improvement in the market cap of real estate companies. And from a bottom of 1.3%, We are now at 2%. But this is all history. What do we see things going forward, right? Now, if I were to look at the IMF data, as per the World Bank and IMF, India's per capita GDP is likely to compound at 10% between 24 and 28. And if that happens, and if inflation continues to remain in the range of, let's say, 4 to 6%, which means that, again, after many, many years, almost 20 plus years, we will have a situation where our per capita GDP will grow faster than inflation, which means that real per capita GDP will be positive. And as we've seen in the previous cycle, not only in India but even internationally, that when that happens, the real estate sector booms. And we believe that we are in the early stages of that boom. So the question is that the current 2% share of real estate in the total market cap, where can it go? Well, directionally we are very clear, it's likely to go up. Now, whether will it be 4%, 5%, 6%, we do not know. It really depends on how fast our per capita GDP grows. But let's say, for the sake of argument, if I were to say that, let's say over the next few years, it even goes to 5%, right? And the per capita GDP compounds at 10% a year, then real estate market cap has to go up at least 150% at 5% share. Now, whether it's 5% or 6%, as I said, only time will tell. But directionally, we think that there is a significant upside when it comes to where the market cap of the real estate industry can be over the next couple of years. Another very interesting data when we studied the real estate cycles in India was that between 2002 to 2007, which was the best years for real estate in the country, a lot of the growth in the real estate industry was price driven. And the data is staggering. If you looked at the real estate prices per square feet in Delhi, for example, the prices in those 5 years compounded at 23% a year. Yes, 23% a year compounded rise in prices of real estate. I'm not talking about stock prices, I'm talking about price per square feet of real estate. Bangalore, 19%, Mumbai, 18%, Kolkata, 16%. Now, during the same period, inflation as measured by the wholesale price index compounded at only 5%. So basically, your real estate prices were growing at 4x to 5x of inflation. Now, obviously, our per capita wasn't growing that fast, but house prices were flying. Obviously, there was a lot of speculative demand. There was a lot of investors which were active in the real estate industry, and a large part of the inflation or growth in real estate was largely price-led. And if you take the period from 2018 to 2023, right, if you take that 5-year period, the very recent 5-year period, what were the numbers? Real estate prices have compounded at 1% in Delhi, 5% in Bangalore, 1% in Mumbai, and 5% in Kolkata. And this was a time when the wholesale price index has compounded at 6%. What it means is that real estate prices have not even kept pace with inflation. And therefore, going forward, there might be a case where real estate prices might do better than inflation. Having said that, unlike the previous cycle, we believe that in this cycle, more than prices, it is likely to be a volume-driven bull market in real estate. And we believe that the profitability of real estate companies will depend not just on price hike. Yes, there will be price hikes, but it will depend on volumes. And here again, if we look at the data, let's say from 2019 or 2018 to 2021, the booking area growth or square foot growth was 8%, realizations were flat, and hence the booking growth was entirely volume led. If you look at the period from 21 to 24, that is the very recent 3 years, the booking area or the square foot growth was 26%, price growth was 13%, and therefore total booking value growth was 39%. So now what we are seeing is that volumes are a greater determinant of booking value growth. There is some price growth, but it is largely led by volumes. And we are seeing that as real estate companies launch projects, they are pretty much able to sell out most of the inventory. And we believe that over the next couple of years, the fundamentals of the real estate industry are pretty solid, and there are a few very good structural drivers that we believe will continue to be strong for the industry. One, we believe that there is a tight demand versus supply dynamics, and the market share of listed developers is growing. There has been a massive consolidation in the real estate industry. All the weak hands are out, very few players are surviving. They are the high quality players, most of them are listed, and they are gaining market share. Secondly, there is record low inventory across markets. Third, we are seeing very strong sales velocity, a record low time to sell out the entire project. Fourth, we see a price uptick led revenue potential of the inventory for upcoming planned projects. So we are now also starting to see a price uptick. As I told you, there has been a brief period post-COVID where prices have not even kept pace with inflation. And we think that for real estate companies, there is both upside to margins and operating cash flows. And in this cycle, the balance sheets of real estate companies are deleveraged as they are more disciplined about how they generate cash flows and manage their balance sheets. So friends, we believe that real estate is a very attractive investment opportunity in the stock markets. We believe that the share of real estate in the total market cap is likely to go up substantially, and you will see that increasingly our portfolios are positioned where we have started to allocate a reasonably good percentage of our investments into the real estate sector. We will continue to monitor this, but all early signs and research of previous cycles make us fairly confident that this will continue to be one of the leading sectors for the next couple of years. For now, thanks. Until the next month.